Hey everyone, this week I'm going to focus on the recent retail sales data release. Now, many investors think the retail sales numbers are only relevant to retail real estate or maybe industrial real estate. But we also have to consider that consumption drives close to 70% of the US economy, and consumption is comprised of the sale of both services and goods. Retail sales are the goods part of that combination, and the value of retail sales is equivalent to about 25% of the US GDP. So while retail sales are particularly relevant to retail and industrial real estate, they also influence all other property types through the broader economy. Now, the July retail sales numbers beat expectations, climbing 3.9% on a year-over-year nominal basis. But when that number is adjusted for inflation, the gain was just 1.2%. Core retail sales, which omits the volatile auto and energy costs, are up by 4.4% compared to last year. But on an inflation-adjusted basis, the gains were just 1.3%. If you look at the longer-term trend, inflation-adjusted core retail sales have basically been flat since March 2021. We had the post-pandemic surge when everybody was spending stimulus checks, but since then, retail sales haven't grown much. But all things considered, retail sales have been holding up better than many expected. Considering the weakening employment market, the impact of tariffs, and rising debt levels, consumer spending has been outperforming. Now, one of the headwinds for retail sales that frequently comes up in financial news is consumer debt. Credit card debt is at a near record $1.2 trillion. Auto loan debt is at a record $1.7 trillion. Mortgage debt is at a record $12.9 trillion, and total household debt is at a record $18.4 trillion. And all those headline numbers are frequently reiterated in the media as a sign that consumers won't be able to sustain their spending levels. But we also have to consider that wages grew by 3.9% in the last year. Debt is up, but so are wages, and wages are increasing faster than inflation. And if people are earning more, then it makes sense that debt levels can increase without being a problem. Credit card debt as a percentage of income is about 4%, close to the 10-year average of 3.8%. Auto debt as a percentage of income is 5.5%, below the 10-year average of 5.9%. Mortgage debt as a percentage of income is 43.2%, also below the 10-year average, which is 44%. And finally, household debt as a percentage of income is 61%, well below the 10-year average of 63.8%. So even though the debt numbers are high, when you factor in income, they're generally lower than they've been historically on a percentage basis. Now, I will point out that the debt loads are disproportionate. People with higher incomes are generally carrying less debt, and people with lower incomes are carrying more debt as a percentage of their earnings. So when it comes to spending, higher income households are contributing much more to the retail sales figure than lower income households. Another key consideration is savings. Total savings, including money market funds, is up by an inflation-adjusted 4.3% compared to last year at $25.9 trillion. Savings have been trending higher for the last few years, and they're just shy of the peak set in 2021 when the stimulus checks were going out. So consumers have the economic ability to support continued retail sales gains, but will they? Consumer sentiment fell last month, and concerns about tariffs, inflation, and the employment market could cause people to rein in their spending. So, for commercial real estate, the current retail sales outlook still suggests that retail real estate will remain healthy. Retail property vacancy rates have been nudging higher over the last 2 quarters, but the overall vacancy rate remains below 5%, which is low by historical standards. Grocery and necessity-based retail properties are positioned to perform best. Retail properties that are more reliant on discretionary income will vary depending on the economic strength of their client base. Nonetheless, the limited construction levels will be a positive for all retail assets. Industrial properties, especially those in the Western U.S., may face weaker demand as tariff policies influence import levels. With tariffs on Asian countries running higher than European imports, the trade impact in Western markets will likely be more pronounced. But the good news, again, is that industrial development is slowing considerably. For now, retail sales continue to support economic growth, so their impact on multifamily and office properties remain modestly positive. But there are still a lot of variables in play, which is why investors need to keep their eyes on the horizon.